SD Bullion.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Report. Another wild week in the markets, Eric. We had the Dow closing over 15,000 and the S&P 500 over 1,600. Bernanke right now is likely congratulating himself, at least temporarily, as interest rates remaining pretty low. The stock market is making new highs with all the funny money, and the metals have just crashed in the last month. So, however, I suspect that Bernanke's goal is simply to somehow keep things held together through the end of the year and then get out of Dodge and let Yellen or whoever replaces him take the blame for what's coming, Eric.
If there was talk about him not actually coming to the Jackson Hole meeting, and that's like the number one policy wonk festival for central bankers worldwide. If he truly doesn't show up on Jackson Hole, and I believe that's August, if I remember correctly, that'll be a telltale sign that Bernanke's getting ready to get out of Dodge.
Right. Just I think it was about 2 weeks ago, there was a press release that Bernanke had a scheduling conflict with the August Jackson Hole meeting.
Sure.
So really the big action in the metals this week was on Wednesday with the convergence of the FOMC statement, where the Fed stated that they may increase or decrease the pace of QE as needed, which is really a big dovish shift from the last couple of months where all of the Fed governors have been implying that QE is going to end later this year. So they changed their the wording a little bit to say we may actually increase it if needed. That coincided with the Sound Money campaign's Buy Silver Day. And we saw the metals rated in the morning prior to the FOMC statement, a little bit off the usual MO of smashing them right on the release. But especially with that dollar dip in silver on the day of the Buy Silver campaign, the silver demand was absolutely unprecedented. I know that for SD Bullion, our highest sales day in history had been the Monday takedown on April 15th, 3 weeks ago. From our other peers and competitors, many other dealers had stated the same thing, that was by far and away their biggest sales day ever. Well, on Wednesday, in the Buy Silver Day, we had 4 times more sales this Wednesday than we did on April 15th. 4 times the sales volume. And really, it wasn't just a retail phenomenon. By mid-afternoon, the largest U.S. wholesaler had completely sold out of all silver. They weren't selling 1-ounce bars, rounds, 10-ounce bars, or even 100-ounce bars. They just said, we're not selling silver. They had said that on Monday the 15th in the afternoon. That's really the only other time we've ever experienced that. And even by Friday, Silver Eagles are nearly 3 months out, meaning that you pay up front here in the first week of May, and your silver is going to be shipped in August. Maples are still about 4 to 6 weeks out. And now even the 100-ounce bars are 3 to 4 weeks out. So we're talking 100-ounce bars are on about 1 month delay. We've never seen anything like that, Eric.
There have been reports as well over at KWN with Bill Haynes saying that one of his suppliers, and you believe it was, sorry, I forget who it was that you were suggesting that he may be referring to, but the availability of 1-ounce bars is an open question, and some suppliers are just not even taking orders at this point. And this kind of speaks to what we were talking about last week, where it would be expected to see wholesale supply chain possibly have trouble with order restocking with bullion dealers, and that's beginning to manifest itself. So natural implication of that we should be watching in the weeks ahead is that it should lend support to higher prices. Do you remember the name of the supplier that he may have been referring to?
I'm not sure positively which supplier he was referring to, but just more anecdotal evidence from our own experience with SD Bullion. We were running a big generic round sale on Wednesday, really, because that's probably the lowest premium right now, as well as one of the most available products. And they're at one of the largest U.S. mints, and when we were calling them to place the order, they wouldn't just take the order. They would take our message and take about 30 to 60 minutes to scrambling to try to find the actual silver bullion, and then they'd call us back confirming what price they'd been able to lock it in at. And they wouldn't take the order immediately over the phone because they weren't confident they could source the silver.
Right. Now, you said that you're seeing that the U.S. Mint is now putting people for allocation on as late as 3 months delivery. Is that correct?
On allocation. So the 12 U.S. primary suppliers are on allocation.
Right.
the primary suppliers are basically selling forward their allocations. Each primary supplier is not the same in their delay. It depends really on what premiums they've been selling at and managing. But those who haven't raised premiums fast enough, they're now 3 months out because they've sold through their allocations for the next 3 months.
I mean, the time level there suggests something that's similar to what happened in 2008. Would you not agree? I mean, that that kind of a push-out is something that we haven't seen since those heady days of 2008.
I'm not sure.
And it makes me wonder if, in fact,
I'm not sure even in 2008 if we saw 3-month delays on Eagles. They were...
Yeah, well, in part, they had shut the mint down more aggressively earlier part, at an earlier stage than the demand spike that we're seeing now. I suspect that might have something to do with what happened in 2008 versus the lead times we're seeing now. But bottom line is, it's a really unusual lead time. And sure, there are other products available that people can point to and say, hey, there's no physical shortage. You can still get generic rounds. Well, folks, if you see this kind of action for the most popular products, it's going to trickle down eventually because people will not be able to buy the most popular products, and they're going to be forced to buy generic rounds, etc. And as those time delivery commitments push out, we'll have further confirmation that the supply chain is drying up.
Right, and as I was mentioning, even this week, even generic rounds were not available on demand, which that's completely unprecedented.
Yeah, and I believe we were speaking about that as something to keep an eye on in our last show as well, too. So if that trend continues, then I think our call for the physical market setting the bottom generically across the board is going to come into play in May.
It's sure starting to look like silver and gold have bottomed in the second week of April. It'll probably take a couple more weeks of consolidation and working to the upside to confirm the bottom's in, but both with the physical demand as well as the price action, it looks like we've seen a bottom.
There really is no great incentive for the bullion banks and J.P. Morgan's management of silver in particular for them to push prices lower because they have already created this monstrous upswing in physical demand that has ramifications to their paper management tools going forward. If we have already seen, starting in August and through the whole capping effort that had began in earnest from October of last year on through April, that the comic supplies of inventory in both silver and gold are declining, and there's this you could even call it a run on the comics bank of physical silver in their inventories, and where this gold and silver is going remains to be seen. It's probably eventually flowing eastward and also to high net worth clients who may have accounts at J.P. Morgan or just in general are demanding to have their bullion moved into allocated storage outside of the comic system for fear of the ramifications of living in a post-MF global world. The general distrust of the banking system is on the rise, and that in combination with this whole mechanism that the bullion banks have been using in conjunction with the central banks to cap prices is beginning to erode, and it's going to be a process. It's not like you can point to any given month and say, the comics is going to explode this month, or implode, better said, this month. But, the bottom line is that the paper fiat system is under extreme strain because the physical markets are now beginning to assert themselves, and there is a price difference in the products that you can see that the retail person buys, and that speaks to this dynamic, and it also is confirming what you see with the inventories of the comics on decline. So it's going to be an interesting summer, and I suspect that the typical sell in May and go away phenomenon with the general equities market is not going to play out this year, and that's going to surprise quite a few people. A great deal of what is driving that is just simply international monies coming to the United States as a so-called safe haven trade, and people look at that and say, well, how can you call the United States a safe haven, or how can you park money into assets where the dollar is going to decline? But on a relative basis, the U.S. dollar actually looks more secure from a political jurisdiction point of view, and also from the speed at which, compared to, say, Japan in the most recent period, has been devaluing its currency. So when you talk about the global forex market and the assets that underlie it, when people liquidate stuff in fear of Cyprusing of their bank accounts in Europe or what have you, you're talking about money flows in the trillions of dollars, and it doesn't take much of that giant sea to be skimmed off the top and push equity prices higher at the margin in the United States. So that's part of the reason why we're seeing new highs in the Dow and in the S&P, and it's also supporting bullion. And we should see the reflation trade going forward in earnest this summer. And the whole seasonal period of bullion being weak, typically in the summer periods, is also not going to happen this year, in my estimation, given the fact that we've already had a substantial crash, and given the reemergence of this inflation trade. You can see it in the prices of copper, movement in oil. It's something that's being expressed across the board. So when the market speaks, the hedge fund momentum players notice it, and we'll probably see a lot more incremental movement into the markets from those folks as well, too. May will be an interesting month, and I suspect that a lot of the doomsayer crash pundits and prognosticators are going to be surprised when they see metals rise simultaneous to equity prices rising. But that is what happens when you go through an initial inflation stage, and that is, in fact, what is being priced into the market right now. It's very apparent in the asset prices, and all one needs to do is just look at how we've bounced out of April.
Back for a moment and touch on and highlight your comments about the COMEX inventory drawdowns. JP Morgan, I think just Thursday, had another big inventory withdrawal, but it's becoming such a big issue that I just wanted to highlight again for our readers who may not have picked up on the comments on Tuesday. The CME president, Terry Duffy, was interviewed on Bloomberg, and I'm just going to read you the following quote because it was pretty eye-opening for president of the CME to make this remarks. He said, what's interesting about gold, when we had that big break 2 weeks ago, we saw all the gold stocks trade down significantly. We saw all the gold products trade down significantly. But one thing that did not trade down was gold coins, tangible real gold. That's going to show you people don't want certificates. They don't want anything else. They want the real product. To me, that was a pretty eye-opening statement coming from the president of the CME, that saying that people don't want certificates, they don't want paper gold, they want coins, tangible, real physical product.
Yeah, whatever happened to somebody talking up their own business? I mean, maybe he'll be calling you next and putting in an order for some bullion.
It's amazing coming from the president of the CME.
Yeah.
But really, we're seeing that really the world over. The GLD stocks just continue to plummet, and whether that's to shore up bullion for other places or continued hedge fund liquidation, but it appears to be investors worldwide are moving more towards the physical product.
Yeah, there's absolutely no question that a portion of that liquidation in GLD is being translated into physical buying. And the media, the financial media, Bloomberg, Wall Street Journal, etc., they don't cover that when they talk about this new bear market upon us. And they use the GLD's decline as the primary example. You know, all of these ounces that are apparently just being sold into the open marketplace, and the associated drop in investor demand for paper is something they point to illuminate a change in the sentiment for the overall market. But they fail to underscore the fact that it actually is a long-term shift that will support a longer-term run in the duration of this bull market, because people are going for physical. And when you have a fractional reserve gold and silver-based paper system where 99% of the people that have been buying and thinking that they hold bullion have in fact only had paper claims to price movement, you know, it doesn't take a rocket scientist to understand that as the shift towards more bullion exposure in the physical form as opposed to paper continues, that's just going to support higher prices because it's actual physical demand in a very limited supply, whereas with the rehypothecation and hypothecation it's possible with these paper products could ad infinitum create more bullion products available to soak up investor demand. So this is a telltale shift, and I think over the longer term it actually will signify the birth of maybe even the latter stage of the second phase of the gold and silver bull market, or maybe even the start of the third phase as we continue on this currency war and central bank devaluation fiesta that the policymakers are so intent on inflicting upon our populations. Once again, be an interesting summer. I think that we'll be able to tell as the months come with greater clarity how these dynamics are going to unfold.
Be interesting. We suspect it may not be a normal summer where selling may go away as the reflation trade and the liquidity from Japan and the anticipation of further liquidity from the Fed begins to be priced further into the market.
Yeah, and we also have the budget debate that's going to be going on in the United States, debt ceiling issues, continued political impasse between Republican and Democratic parties, and Obamacare coming into full force in 2014, and that serving as a significant drag on economic activity going forward. I suspect that by the summer end and moving into the fall, that the whole round-robin rotation that we've seen, with Japan being the most recent aggressive actor in QE, will have passed the baton to Europe over the summer, and that by the fall the United States will be in full QE to infinity mode once again, with all of the policy wonks speaking about it in the press and people pricing that into our asset markets again.
And look for the UK to be back in the game too, with Carney coming on board the Bank of England as well. All right, well, so we had a continuation of massive physical demand in the gold and silver markets this week, really culminating on Wednesday in the buy silver campaign. The physical silver shortage has just continued to lengthen and worsen. We had another big smash on Wednesday as well as Friday morning before the jobs report, but the metal's recovering into the close on Friday. So it should be an interesting week ahead in the month of May. So for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets Report.